Good morning or afternoon, depending on what time you're joining us. My name's Steve Ernest. I'm one of the partners at the Fortra law firm. I am also the director of litigation and bankruptcy there. And as it's appropriate today, I am the Western Lawman. And it's my great pleasure to have with me today for our Campfire Chat a good friend of mine and a great client of the firm and frankly, a titan of the private lending industry, Sam Chivitchian. So thank you for joining me.
Thank you, Steve. It's always a pleasure.
I'm glad you're here.
Meeting you and having great conversations.
Thanks. So tell me, or tell the audience, Sam, who you are and who you're with and what is it that you guys do?
Yeah, so Sam Chivitchian, I'm with Secured Capital Lending. We're a private lender based out of Los Angeles, and so we're direct private money lenders. We lend all over California and nationwide. So we kind of have our two sides of our business, which is the nationwide, which is our private money business, where we do all the residential fix and flip, ground up construction, DSCR. And then in California, we have what's our true asset-based, equity-driven kind of hard money loans, where we'll do second trust deeds, some land loans, some commercial bridge loans, cross-collateralized loans, some of the out-of-the-box type of lending that a lot of our competitors won't do. So yeah, I've been Secured Capital. I started 9 years ago. I got into private money 15 years ago, was with another colleagues of mine for 6 years at another fund. I do come back from the background of mortgage lending. Back in 2003, was a mortgage broker up until the market crash in 2008. Then forced me to adjust and transition to the market, where I got into the investment side and fell in love with private lending, and here we are now.
So you said a couple of things I want to follow up on. You do nationwide loans, 50 states, 48 states, a handful of states?
So I would say it's probably most of the country, so about 30 plus states.
Okay.
Yeah, and it's mostly the states that we try to shy away from is the judicial foreclosure states.
Right.
Yeah.
And with your local, sort of your bread and butter hard money loan business, do you have collateral types you look for? Do you have minimum and maximum loan amounts? What are the sort of parameters that you have around your business?
Yeah, great question. Yes, so we basically in California, since it's our backyard, we've been kind of lending in 15 years and we know the market's much better. We're a little bit more aggressive than we are on our nationwide. So we'll do anywhere loans from 100,000 up to 20 million. And so we'll do second trust deeds. Our interest rates will range anywhere from 10 to 12%, depending on if we're a first position, second position, if there's a construction component or not. What's unique about our structure is we found that a lot of our private money competitors, they're either fully focused on residential or they're just focused on commercial. We cover both areas. So we'll do anything from single family, residential to multifamily to office, industrial, retail, mixed use. So some land, as I mentioned. But when it comes to our true asset-based lending, it's not so much the guidelines like the private money loans, because private money loans, you follow like a set guidelines with experience requirements and FICO requirements, where on the asset-based lending, it's very case-specific type of. So we underwrite each deal. We look at the asset type, we look at location. So like, for example, a deal out in Central California, for example, in Bakersfield, we're gonna be more conservative versus a deal in Studio City in LA, for the same asset, same use, same borrower.
So you said land, unimproved land?
Yeah, so we'll do land where any land that's in urban and metro areas that's not hillside. We do land that's in urban metro areas where it's flat. We know we can get a permit or entitled in 3 to 6 months. So we'll do those, but we're more conservative. We typically would try to stay under 50% on those.
So you said your loan cap is 20 million. What's the biggest loan you've ever issued?
18 million.
Right up there then.
So and the larger loans are usually our commercial bridge loans. So those are like more bridge to stabilize, we call it, which is basically someone just developed a multifamily or let's say a brand new multi-tenant retail building, and they're like 99% done, and then their construction loan term goes out, and so they need 6 months to stabilize before they can go to a bank. So that's when we'll come in and we'll give them a bridge loan, and those are usually larger because now they've already developed it, and so we'll do those bridge loans to stabilize.
So your $18 million loan, is it still outstanding?
No, that paid off.
You got your money back?
Yeah, that was a few years ago. Yeah.
Nervous?
Yes, very nervous because we did have some bumps on the roads, couple extensions and everything, but finally it did pay off. So.
All right.
Actually, we take pride in that, since you brought that up, is over the last 15 years, we've probably funded over $1 billion in private money and over, 1,000 transactions, and our default rate is less than 0.1%. So we have a 99.9% no default rate.
So industry-wide, it's 2.6 or so.
Oh, I didn't know that.
So you're, I know a lot of stuff, man.
Yeah.
So you're well below 0.1%. That's sort of an anomaly. Good for you. You're not the guy to mess with, I guess.
No, I mean we take our investors very money very serious, and we're not the lenders that underwrite lend to own type of perspective.
So 0.1%. Like, what happened to that guy? It's got to be just like one person, right?
I can't put an exact number on it, but I think maybe we've had 5 foreclosures over maybe 1,200 loans. I don't know. I might, I'm just estimating, but it's a very low number, and it's one of those like you're gonna have some bad apples. As much diligent you want to be, you're gonna have things that have unexpected events that happen, like in someone's life or something where. It takes a turn, or like a global disruption like COVID or pandemic where someone, business got hurt so bad and just on circumstances that were not in their control.
What's the LTV you look for?
Well, it depends on the loan product, right?
Of course.
So on our bridge lending, asset-based loans, we're usually 50 to 70% depending on the asset type or location. But on a fix and flip, we'll go up to 85% of the purchase and 100% of the rehab, as long as the LTV on the ARV is 70% or lower, which is kind of the general threshold for fix and flip.
So even these 0.1 guys, you got your investors' money back probably.
Yes, we've never lost a penny. Even on the foreclosures, because there was enough equity, and I mean the last 15 years since 2010, we haven't had a real downturn, meaning like a big dip. We've had some disruptions, but never. We haven't had a market crash or a recession where it came to that. So everything that went default, we were able to recover fully.
So you've been doing this 9 years. Some things change quickly, some things evolve, as they say. You indicated you do seconds. You have second trust deeds?
Yes, so we'll do seconds, case by case. It's not a big portfolio of our business, but we do them, yes.
Big change in that the past month and a half, with that AB 130.
Yes, so that is something I need to talk to you more about and get more informative. We haven't done a second in the last month, but I've been hearing about it, and I do need to kind of learn a little bit more about it before we continue doing our second.
Yeah, if you're issuing seconds now, you're the only one.
Oh, okay.
Over the past about 60 days, that market has evaporated. But the evolution, so in 9 years, nothing's ever going to stay the same. How have you seen the private lending market change in the 9 years you've been in it?
Well, I started 15 years ago, and I think I can paint a better picture if I go from when I was at my first fund. In the change and how I've seen this industry, this space grow is just night and day. So like I remember I did my first private lending conference in 2011, and it was only 30 people. It was just like 30 guys. There was no capital providers. There was no third-party vendors or any nationwide lenders. It was just like individual investors who were like traditional hard money. So it was very small, but there was, I always felt like there was so much potential to it, and it wasn't until, I believe, 2013, 14 when institutional money started getting interested and actually started investing into the private lending space. And so this kind of opened up the secondary market, right? Which then, you know, Wall Street and a lot of hedge fund managers. So a lot of people started getting attracted to private credit and transitioning over to this side of the industry, and just the market of lenders and borrowers and I mean, it gave a platform to investors and resources to investors, real estate investors, to do things that they could never imagine. Like, for example, if you wanted to develop a property or rehab a property prior to 2014, 15, you would have to go to a bank, and the bank was going to be super conservative. They were going to do a full financial doc review, and you're probably going to get denied, or if you got it, maybe you would get a 50 LTV loan with 50% loan to cost, which no one really could put that much equity. Where private lending came into play, now it's saying, okay, you know what, we'll give you 80% cost, you know, and we're going to underwrite the property more or the project more rather than your personal financial statement. So it came more about experience and putting a good deal together.
So yeah, the advantage from both sides, the borrower and the lender, of the private equity arena is its agility. It's quick to respond, and it's short to close sometimes, rapid to close, not short to close. But what sort of borrower profiles or collateral packages have you found the most success with?
The most success has been with borrowers that came from a background of construction or development, meaning like contractors, you know, subcontractors, and rehabbers, and so for those borrowers that really understand the mechanics of construction and how to manage projects and how to follow set proper or realistic timeline schedules for construction. Because what would happen is a lot of the loans that you end up having issues with is new investors coming into rehab projects or development that don't have a construction background, and they think they're going to be able to pull this off in 6 months, and then they start having so much setbacks during the construction process because they're not managing it well, and so they don't have that experience, and then 6 months becomes 12 months, then their liquidity gets dry, and then now they fall behind. So I've learned that the first, probably most investors that I've talked to that got into fix and flip on their first 2 projects, they either broke even or lost money. If they didn't have a background in construction. So that's why you have a lot of fix and flip lenders that will not do first-time investors. So what we did was to solve that or fill the gap in that area. Is we will do first-time investors on fix and flip, but we won't do first-time investors on ground up, because it's more riskier, it's more complex to do a ground up development. But on a fix and flip, we will do one, but the only condition we add is we say you can't manage it. We want a licensed GC. If you don't have the investor as experience as an owner, we at least want a licensed GC to be managing the project. This way we know the timelines and schedules realistic.
So the timeline, let's follow up on that. The duration of a hard money loan is generally much shorter. These aren't 15, 30-year residential mortgages. What, for a ground-up construction, what is the timetable that you would typically expect?
So depending on the scope of work and the type of project, like for example, like a ground-up single-family development, you can get done in 12 months. But a ground up multifamily is probably going to be 18 to 24 months. Just a bigger, a lot more heavy construction, just bigger scope of work. So first, you underwrite the budget and the scope of work. Based on that, you put a more realistic timeline schedule and underwrite, okay, this project's going to take 18 months to build and then maybe 6 months for stabilizing and exit.
And then you're providing draws as it goes. It's not like they're getting $12 million at closing, right?
Yes, exactly. Anytime there's a construction or rehab component, those funds are reserved and held back. They get released in draws. So it's more like a reimbursement process.
So you'll reimburse the borrower, or you will only send that money directly to the vendor, like the concrete guy or something?
I know some lenders will choose to do pay the contractor, for example, but I think for us, and from what I understand, the traditional way is we pay the borrower pays the contractor. Actually, it's the vice versa. So when we originate the loan, once the loan closes, project starts, the borrower will need to have a certain budget reserve to kickstart the project. So he'll pay the contractor, let's say we'll do the first phase of the construction. We then come verify, inspect the property, that the work is complete, and then we reimburse the borrower for what he paid the contractor.
How is it that you evaluate your borrowers other than just sort of credit scores and the way they sound and present on the phone? Like, how do you build this trust to give someone $18 million?
There's really two parts to it. I mean, experience is a big factor. So we do verify track record, right? And then we do look at credit. It's more of a global view we take, and then we also want to hear their story, right? So it's very important because what they'll tell us their background, they'll tell us the purpose of the loan and their whole plan of the investment, and then the whole exit plan, how to repay. We like to call it the triple Ps: purpose, plan, exit plan. And I've really followed that for many years. And if I want to hear their story, and their story is supposed to answer me, what is the true purpose of them taking this loan? What's their real plan of investment? What type of rehab? And then really, how do you plan to repay this loan? What's your exit plan, right? And if the story I can't connect the dots, or he can't support his story with certain, documentation or diligence that I need to really connect it, then I'm going to start conditioning more, asking more questions, and eventually we might pull out of the loan. But so it's really getting engaged with the borrowers, understanding their story, and then us doing our job, which is doing the full due diligence on the project, the ARV appraisals, the budget reviews, making sure that the project pencils out, that there's a decent profit margin there, and so this is kind of how we get comfortable. So.
And you go out and touch your projects yourself. You're a bit of a YouTube sensation on your own. I've seen your videos, and so you go and you walk the pavement and touch the buildings yourself.
I try to, the local ones at least, right? If it's local, I love. I also have a side development business on my own. I love to build, and so I enjoy.
Like tool belt and boots and the hat, Bob the Builder.
I would like to lie and take credit for that. No, I'm doing a lot of like SB9, ADUs, affordable housing project now.
Do you have a nail gun?
Do I have a nail gun? Not exactly.
Do you know how they work?
I've seen them get used, and it seems too dangerous for me, so I try to stay far away. But what's been kind of unique is when you are a lender and then you start getting into development and getting that experience as a construction, then you can relate and connect with your developer borrowers so much better, because now you can step in their shoes and understand their sensitive like pinpoints and know how to address them, and actually it gives us an advantage on the underwriting and being able to get comfortable with deals quicker than, let's say, a lender who doesn't have a background in development.
So here's an ethical question for you. You'll enjoy this one. Will your fund loan money to a borrower who has hired your development company to do the work?
No. So first we've never done that, and I don't think I'll be open to that. It's just it makes me feel that it might create a conflict of interest.
For sure.
Yeah. And that's one example, and I can probably think of a few other examples where I've had borrowers ask me to help them in services or related to development that I could have because I had the experience, but I chose not to because it creates a conflict. We have to be careful on how much we overreach our boundaries, and so because liability in this business, especially in the state of California, can be very costly, and we don't want to go that route.
If you did that, though, it would be very easy to verify the completion of the work. You would know. You'd know on both ends when they're asking you for a draw.
Yes, exactly. We would, but again, we can't control. At the end of the day, the borrower has to make the payments. The borrower has to, as an owner, as an investor, has to manage the entire project. So if they start not performing on their end, and then guess what's going to happen? They're going to start blaming us if we're like in some sort of a development partnership or equity or some sort of capacity involved in that project, like I said, directly. So then we can't, once we start exercising our options to try to get them to repay the loan, they're going to look for ways to say, hey, you delayed us on this, or make up stories.
Yeah, it's your fault. Sure.
Yeah.
So you've indicated that your default rate is 0.1%, which is unheard of. It's extraordinarily low, so congratulations for that. Do you have sort of risk management or fraud protection strategies that you've employed, or it's just careful evaluation of your customers or your borrowers as they come in?
I think it's mostly focused on making quality loans, so it's careful evaluation of borrowers and saying no a lot of times for deals that are in the gray areas, but also you personally in Fortra Law, we've been partnering with you guys for 12, and I bug you time to time a lot, and Kevin and Nima and Melissa. So anytime I feel where there's a loan or a situation where it might become a risk of liability, getting the proper legal counsel and advice has been instrumental in helping me make better choices and becoming more legally savvy in my field. When you work with thousands of brokers and borrowers, you start to categorize in certain groups of types of the types of questions you get in person. Like usually, they have a lot of similar attributes to them that usually will end up translating to issues like people who are just everything is focused on being extra aggressive or extra bullish, and they want all the extra leverage. They don't want to put any skin in the game, and they're only thinking about the upside, and they don't want to, in their analysis or in their due diligence, they don't think about, okay, do I have an exit plan if plan A doesn't work, right? So we talked about hearing their story, when it's all, the promising the moon and the stars, and then when I start asking, well, what's going to happen if that partner that you're waiting on that's going to come in and is going to help you, what happens if something happens to his business and he can't help you if you're, and then I hear them kind of get stuck, and then that's a red flag. So
it's amazing how people won't plan for any contingency, right? Their plan assumes that everything is going to work the way they say.
Yeah.
And it's not that they're necessarily trying to trick you, it's just they haven't considered incremental failure.
Exactly. And I think that experience is something you can't replace. And if it's someone, especially the younger investors or newer investors who are just, maybe they did one project and they made a lot of money, and now they think that's going to be every one.
It's going to be like this every time.
Yeah, and so sometimes my colleagues will say, you're too negative, like, you always focus on the negative first. And I'm like, yes, because if I can get comfortable with the downside of this deal, everything on, we know it has a lot of great attributes to it, and that's, everyone can get comfortable with that, but I need to first make sure that all the loose ends are covered here from the beginning, and then we can, the positives, no one's going to disagree or be opposed to that. So.
Right. Life is a series of low-grade nuisances, and you have to account for those.
Yes. If you can get comfortable with that, then everything else should be fine.
You've been at this better than a decade. So looking back, what is a lesson that you've learned that you can share with the viewing audience at home that might be helpful to them?
Try to surround yourself with the right people, the right team, when you're getting into this business, so that you don't make big mistakes. No one is perfect. You're going to make some small mistakes, and that's fine because you can navigate through that. But in order to avoid big mistakes, I think is, for example, the partnership we have. Make sure you have a good legal counsel like Fortra Law, and make sure you have a good construction servicing, rehab servicing team that can help you on budget reviews and feasibility reports. Like, don't try to do everything on your own, and also don't force things. Like, I've always believed in the business model is you do what you're good at, and then based on the demand that you're getting or how the market's going, then make those decisions to branch out in other places. So don't force it, allow it organically and naturally to take place. This way you are not forcing things, you're not over leveraging yourself just to get into everyone wants to scale, but the question is, when is the right time and at what pace? Because you don't want to overscale and then over leverage yourself, and then my market takes a small turn and then everything crumbles. So that's the general advice that I can give.
Yeah, build a good team in-house and then surround yourself with the right vendors who can fill in all of the discrepancies or gaps.
Yeah, because no one is great at everything, right? There's a saying, if you're a master,
speak for yourself.
yeah, except you, Steve. Yeah. But
I'm glad you noticed.
Focus on your strengths, and then whatever is go to the right third-party vendors, and you don't always have to. It's not always about the money. Yeah, you might make a little more money and do the loan servicing in-house, but if you don't have the proper infrastructure to handle that and manage it, that can backfire. So focus on what you're good at, and just organically grow.
Sure. All right. Well, Sam, I've enjoyed this very much. Thank you so much for your time today.
Thank you for having me, Steve. It's always a pleasure.
It's always delightful to have you. For the viewing audience at home, I thank you very much for your time today, and I hope you've enjoyed this episode of the Western Lawman's Campfire Chats.